out of the School of University of Chicago under Eugene Fama, studying efficient market theory. The question is, do you think the markets are still efficient?
I took Gene's class, and then I was the teaching assistant for 2 years. And I was terrified to get something wrong, so I sat through it for 3 years. About the third week of class, he looks and he tells the students, the market is almost certainly not perfectly efficient. And you get a big gasp. Now, only at the University of Chicago and only Gene's class do you get a gasp with that. Everywhere else in the world, people either go, yeah, we know markets aren't perfectly efficient, or they have no idea what you're talking about, which is often quite common. What he meant, he's an honest guy. He believes they're more efficient probably than I do now, but perfect efficiency is silly. Nothing is perfect. The question becomes, how efficient are they? I think it's fair to say someone like Gene thinks they're pretty darn efficient. Efficient is this idea that prices are accurately reflecting fundamentals. You can get really geeky on how to define that, but let's just be colloquial. I do have a view, it's not a short-term view, it's not a market call, that, again, markets are never perfectly efficient, but over my career, which is annoyingly about 32 years now, I guess the opposite would be even more annoying, but it's a long time. I'm a little obsessed these days with those internet memes of when they show you like an actor like Ed Asner and Mary Tyler Moore was 10 years younger than me when he did the role. It's very upsetting. But over my career, I actually think markets have gotten somewhat less efficient, meaning prices are a little bit more disconnected from reality. It ebbs and flows. It's never the same at each point in time. But I find that an odd view because one tends to think, as technology in particular advances, that things should march towards better, with better, I think, being efficiency in this case. And I actually think maybe I'm biased by having a front row seat, but I think over the last 30 or so years, I'd say the market is somewhat less efficient than when I started.
So why do you say that is? What is causing it to be that way?
It's, well, first I start out by just observing a few facts. And I am, of course, biased by what I've lived through, but I loved Gina's presentation. The dot-com bubble stuff was bringing, PTSD-like memories for me. We try to very formally measure how disconnected from reality or not, or how reasonable are stock prices, in particular, not the price of the whole market, but within the stock market, are cheap versus expensive stocks. You could define that very narrowly in a quant sense in terms of just multiples. You could define it more broadly in terms of a Graham and Dodd sense. Yeah, you want to pay a low multiple, but what's the quality of the stock? What's the risk of the stock? But either way, measured very formally, the dot-com bubble saw by far the largest disparity between cheap and expensive we had ever seen in about 50 years of data. We survived that. It was a little ugly for a while, but we actually thrived through it if you take the whole round trip. But when you almost die in the first half, you tend to remember that. If you had asked me in, say, 2002, when all of that excess was pretty much worked off, are you going to see something more extreme than that in your career? I think I'm smart enough, even back then, to never say never. We don't live in a business where any of us should say never. It's a dangerous word. But I think I would have said it's highly unlikely. That was the craziest thing we had seen in 50 years. I would have said, well, in 20 years, people like me will still be around, I hope, who with some memory. It's not 100 years where everyone is forgotten. And then pre-COVID, it was close. And then after COVID hitting, we saw things measured very similarly. Price multiples or even price multiples scaled by quality to go to levels well beyond the tech bubble and lasting about doubly as long as the tech bubble. If you ever have the misfortune to have an investment that ever goes down for any amount of time, you will learn something that they don't teach you in a PhD program. Severity is bad, but duration is underrated when it comes to pain. 3 years of pain, even if it's cumulatively not worse than a year and a half of pain, is a ton worse. The first year you go back to your clients and go, we think we're right, look what's going on here. They go, okay. The second year, they're like, that's the same thing you said a year ago. And you go, yeah, but it's still going on, and we're still going to be right. The third year, I mean, your mom's still invested, but it's getting tougher. So duration counts. So we've seen both the severity and the duration of those. So I start out just observing facts. And then trying to fill in why. Admittedly, this is a lot of op-ed. This is very hard to prove. And I love to, I'm a card-carrying quant. I love to, produce tables. I can show you these spreads, but why? And I tend to I think it's a multitude of things. I think the number one thing is probably the thing we all love to blame, the internet and social media. I think a lot of people naturally assume such a thing would bring us information so quickly and so ubiquitously, knowing everything, that prices would be very efficient. But that's never been the hard part. When I started in this industry, we got earnings within 20 minutes. The difference between 20 minutes and a nanosecond matters to an HFT. It doesn't matter to almost every other investor. We didn't really materially get more. And I do think that level of information overload gives people a lot of illusion of control. I don't want to go into this deeply because I know you'd like to get me going on this, but I think the meme stock examples, I don't think they're the norm by any means, but I think they're the ultimate example of a little bit of information making you think you really know something very deeply, and I think that gets into market prices.
I'll be careful to keep this a little reined in, but on the meme stock issue...
I knew I'd get that started.
How much are the retail traders that are bidding up prices of stocks like GameStop contributing to this idea that markets are less efficient to you?
I think they are a very small part in dollars. They may be poster children in some sense for the effect. The whole idea that this disconnect in prices can come in a world where we have all the information at our fingertips. I think we're all raised, at some point we've all read about the, quote, wisdom of crowds, the way, if you take a crowd that on average people have 51% information, but you poll them. Hope many of us here are old enough to remember Regis Philbin and Who Wants to Be a Millionaire? The absolute best lifeline was always poll the crowd, right? Because if they asked a question, what does it say on the back of a quarter? 85% of the people don't know. But they're evenly split. And the 15% who do know all go one way. But there was always a little unspoken footnote to the wisdom of crowds. To have a wise crowd, it's got to be fairly independent. If everyone got to talk about the quarter, not look at a quarter, that's cheating, but talk about it, the people who are wrong convince the people who are right and whatnot. A crowd where everyone is coordinated and not independent has the risk of becoming a dangerous mob. And I don't know about you guys, but I can't think of anything better at turning a wise, independent crowd into a dangerous mob than the internet and social media. So I do think they're kind of the poster child. I don't think economically they are that important. I don't want to disparage either side of it, but it's $9 in terms of, NVIDIA laughs at that on a daily basis. The entire meme stock phenomenon is like a little part of a day of NVIDIA. But I think it is a poster child for the concept I'm talking about. There are other candidates. People talk about the role of passive. That's really complicated. I'm not one who just looks at passive and goes, that's causing all kinds of havoc.
What is it causing?
Okay, I'll disappoint you here. People, I don't think we really quite know yet. First of all, here are the things we know about passive. Not everyone can be passive. The whole world breaks down. Even back when I was a PhD student, so this is the early 90s, this is what happens when PhD students in finance get drunk late at night. They sit around going, what if everybody tried to be passive? And that's a black hole. That's a singularity in finance. Nobody's looking at individual stocks. And that just can't work. Passive is free rider. It's a free rider on active managers, making sure prices are somewhat reasonable. But the question of how many people can be passive, nobody really knows.
Do you think it's contributing to inefficiency? And is efficiency, frankly, another way of saying wild swings in markets?
I think I would guess yes, but I think it's pretty small versus the social media, the illusion of control, the data overload things I'm talking about. it's not clear theoretically. Imagine you had a world where you had a certain amount of passive and active, and suddenly a lot of active moved to passive. Whether active is now easier or harder, whether it's more or less efficient, depends on who moved. And let me be really obnoxious and go, there were sharks and minnows. There were people who were good at it and people who were bad. If all the minnows move, markets get really efficient because sharks are trading with sharks. They all are pretty good at valuing these things. And the sharks don't make a lot of money. We don't really know who moved. My reasoning here is really just correlation, not causation. This has occurred at the same time that massive price disparities have grown and lasted longer. So as a pure guess, I would have to go, it's probably contributed something. It's very hard to assign. Another one is, I'm probably the billionth person to mention this, but over the same period, we've had 10 years prior to a couple of years ago of ultra low nominal and real interest rates. I am not a person who thinks that means growth stocks should go to the moon. I've written papers on the math of that's kind of wrong. They're not actually that much longer duration. But the market disagrees with me. The market thinks when interest rates fall, growth stocks should go to the moon. And so ultra low interest rates have probably contributed to a fair amount of that also. So I think it's a witch's brew, but if I had to put the three, I think maybe I'm just an old man ranting at TikTok, but I think the feeling that you own all the information and are on a level playing field, and therefore you can own two stocks and be very confident about it, is probably my number one thing to point at.
So let's step back for a minute, because you were concerned about the efficiency of markets here, and we asked, has the market gone awry? Has something about the market broken to you?
Broken's such an ugly word. These are points on a spectrum. For me, broken is very, I'm going to define that as are we in a bubble, or the opposite of a bubble, an irrational depression, where people won't pay any fair amount for stronger companies or whatnot. A bubble is when we look at the companies people like and they're willing to pay giantly excessive amounts. So let's say bubble and broken are equivalent. I use the word bubble, I think, less than a lot in the industry. I once wrote a sarcastic piece. Really doesn't narrow it down amongst the pieces I've written. But making fun of the term bubble, that on the extended use of the word Wall Street, a lot of people will see bubbles everywhere. And they translate it a little too weakly as a bubble means a stock I kind of don't like. No, that's not a bubble. A bubble, to me, is a vastly diversified set of things that I cannot come up with any reasonable assumptions that could possibly make these valuations work. I have seen two in my career that I think we identified before the fact, and one I was a passive watcher of. The dot-com bubble, which again, the PTSD from the earlier presentation, and then really 19 and 20, when stocks surpassed I would use the word bubble for that. Since then, the way we measure value, and everybody who measures it's one of the hard parts of communication in this world is everyone's going to measure it a little differently, but the way we measure value, we've come in from the new 100th percentile, which was set in the late 2020 period. Sometimes I jokingly call that the 130th percentile, and I wait to see if people think that's reasonable. Then I like to gauge the math level of the audience in those sneaky ways. So the new 100th percentile, which was about 30% more than the old one, that I would certainly call a bubble. I don't think there were any assumptions you could have come up with. We define value as relatively pretty strongly industry hedged, very apples to apples, epic differences in valuations. Right now, after about 3.5, 4 years about 3.5 strong years for the way we define value, that spread is down to the 80th percentile. I don't call 80th percentile a bubble. An 80th can go back to 90th in a heartbeat. There's nothing that means it's going to be a smooth path. I have downgraded value investing in general You look surprised.
Well, actually,
I'm not a perma value guy.
We're going to bring the audience in actually here because that's our polling question. And while we have Cliff answer the value thing, you're teasing it already.
Well, I've downgraded
it. Does value investing still have room to run?
Well, the answer is still going to be yes, because I've downgraded it to something we like on average when it's 50th percentile. We want that as part of what we do, meaning we, all else equal, we prefer to pay a lower multiple. I don't know when we ever wouldn't. At 80th percentile, we do think it's more attractive than normal. So, yeah, by that definition, we do think there's more room to run. But it's not an arbitrage you can drive a truck through. In late 2020, if I may be bold, the challenge was not being right. That was relatively easy. What was going on, I think, was crazy. The challenge was surviving being right. That can be hard. I think right now at the 80th percentile, yeah, you want this as part of your portfolio. Maybe you want a little more than normal. But it's not the opportunity of a lifetime, which it was 3 years ago. If someone is constantly telling you the same trade is the opportunity of a lifetime, you probably want to run.
So speaking of opportunities of a lifetime, a couple years ago, very recently, you've been hitting records at AQR. A number of your funds have just been performing like they've never performed before. Part of that was the value trade.
Actually, less than you would think, but a decent part of it.
Well, what's contributing to it? Because even through the first quarter of this year, many of AQR's major funds were up double-digit percentage points. And what is it exactly that you're doing differently at AQR now than you were before?
There are definitely some things we're doing differently, and I will answer you. Some of it is the fact that if you do the same thing consistently over time, and it is a good thing that works over the long term, sometimes it works for a few years and sometimes it really doesn't. So you can have those kind of streaks without doing something differently. I get very leery of talking about this because the very rough 19 and 20 was a very small contributor to changes we made to the process. We're always trying to make change. We're always trying to get better. Who in the industry is not trying to get better? I think we got a lot better at how we allocate among these geeky equity factors. We've gotten a lot more systematic. For our first 20 or so years, it was probably me and a handful of people saying, what's a reasonable long-term allocation? And we stuck to it. Not to get into an AI kind of theme, but we let the machine decide more. And it took me a while. I probably slowed us down 2 years on this because I think it's my job as an old man at the firm to kind of say, you're going to change to what? But I'm reasonably convinced it's just at least a little bit better than us. So I think that's better. Some of the things we do that we haven't discussed in the world of trend following, I think we've taken a huge leap. And we did price trends since I wrote my dissertation in the late 80s and early 90s. 1990s, not 1980, not 1880s, but a while ago. But in the last 5 years, tremendous weight not just to price, which it was historically, but to fundamental trends. Tremendous exposure to more esoteric trends than just your famous stocks, bonds, currencies, and commodities.
Like what?
Suddenly, I'm walking around and somebody is talking about trading milk. And somebody's talking about trading sugar. And somebody's talking about trading my favorite, Malaysian palm oil. Please don't ask me if we're long or short Malaysian palm oil. I don't take an interest to that level. But I do take an interest in the fact that we trade it. And we found the sweat equity of pushing into newer markets. They're smaller capacity, in basic value investing around the world. And value in a broader sense than just quant multiples, considering quality, more of a Graham and Dodd sense. You can run an awfully lot of money in that. And I think it works. The challenge is it will have its very rough periods in sticking with it. Esoteric commodities, much more limited. There is a certain amount of Malaysian palm oil, and you can't take $100 billion and say, I'm going to be mainly a Malaysian palm oil. But can you add a little bit at the margin and do that in 50 other commodities? Yeah. So we've, again, I don't think this was a response to that tough 2 years. But it did coincide at the same time. So I do think we got better at a whole bunch of things.
I have to ask you about some of the hot topics of the day because you play in so many liquid markets. What do you think about this massive fascination behind private markets? We all know that you think a lot of it is volatility laundering, but
That's
what
a
else
great phrase. Who came up with that phrase?
I wonder.
People exaggerate my mad on for privates. I invest in privates. I think they're a very reasonable thing. I think the A lot of people who do privates are probably the best investors I've ever met in terms of understanding a company. There are people who argue, any investment you can think of as top line, what do you make, the average return, and what is the risk? And you can argue about how to measure risk, but just think of those concepts. The top line is argued about. Do you have to be in the top quartile of private investors? If you buy one of each, what do you make? Is it better? Is it worse? And people fight about IRRs and how to measure that. It's not my fight. The numerator, how risky they are, is where I have gotten my back up a few times. And a lot of people in the private world get this entirely right and are entirely honest about it. They'll tell you, we don't market to market, but we're 1.3 times levered equities, and it's equity-like risk in any medium to long term that matters, and zero problem with that. Every once in a while, and people now send these to me just to rile me up, which, by the way, is an exceedingly easy task. But they'll send me things like a tear sheet for a private fund that at the bottom has Sharpe ratio, realized Sharpe ratio, 10.0. And this actually happened, and it was actually 0.0. I thought that was a nice touch, right? Not 10.2, 10.0. And that'll create smoke out of my ears, and unfortunately, anyone can tell if I'm angry because my entire head turns red. Sadly just passed, incredible man, but Jim Simons, he didn't have a 10 Sharpe ratio on his best day, and was probably the greatest money machine we've seen ever. So when I see a 10 Sharpe ratio, I think, you're doing something wrong here. So I have zero problem with them as investments. I do think it is very dangerous to misestimate the risk, because some people get it and will allocate an amount saying, yeah, we know what they say 10, but it's risky, and we think they're levered, and we know what credit does, and if we have a 5-year bad period, we know we're going to get creamed. Fine. But for the people out there, and I think there is a subset, I don't want to, you know who you are out there. People draw efficient frontiers and put private credit way on the left at like 1.5% vol. If you're actually building your portfolio believing that, I think you're building a bad portfolio. So yeah, I have a problem with some subset of the market that grossly understates the risk and kind of believes it or acts like they believe it.